Welcome to episode 20 of the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoan, and today we've got a packed episode filled with the latest developments and trends affecting the mortgage and real estate industry in Ontario, Canada. So let's dive right in. Our first topic today is a recent report from the Royal Bank of Canada, which suggests that Canada's economy feels recession-like despite showing growth on paper. Now, this might sound a bit confusing, but let me break it down for you. According to RBC, although Canada has avoided outright declines in gross domestic product due to rapid population growth, per capita output is falling, and unemployment rates are rising at levels usually seen during economic downturns. So, is it a recession or not? Surging population growth has prevented a technical recession. Since mid-2022, Canada has added 2.1 million new residents, driving a 6% population increase from the second quarter of 2022 to the first quarter of 2023. This influx has helped sustain overall economic growth as new arrivals have bolstered consumer spending, which makes up more than half of the GDP. However, this growth has masked underlying weaknesses. Without higher population boosting demand, the Canadian economy almost certainly would have contracted outright over the last 2 years, RBC noted. Real per capita output has declined in 6 of the last 7 quarters, and unemployment has risen concurrently. The unemployment rate has increased by 1.6 percentage points from post-pandemic lows, a rise typically associated with recessions. As of June, layoffs had surged 20% from a year ago, and many students and new graduates are struggling to find jobs.
High interest rates and inflation have also eroded household purchasing power. Higher interest rates alongside decades-high inflation in 2022-23 ate away at household purchasing power, RBC reported, per person. After inflation, household spending is 2% below its post-pandemic peak and 2% lower than in 2020.
RBC predicted that interest rate cuts from the Bank of Canada will eventually alleviate some pressure on households. The BOC's easing cycle is underway after an initial 25 basis point interest rate cut in June. We expect 3 additional back-to-back cuts in subsequent meetings will bring the overnight rate to 4% by year-end, the report stated. While these rate cuts will help, mortgage renewals in 2025-2026 will still pose challenges, though they should be manageable if the labor market does not deteriorate further. Households with variable rate mortgages and credit market debt will feel some relief as interest rates drop. The bank said real per capita GDP will likely remain negative through the end of this year, but turn positive in the second half of 2025 as the effects of elevated interest rates continue to fade. New condominium sales in the Greater Toronto and Hamilton area plummeted to a 27-year low during the first 6 months of 2024. This sharp downturn in construction starts in Toronto has continued to impact inventory levels, as highlighted in a new report by real estate research group Urbanation Inc. According to the report, only 159 new condo units were sold in the Greater Toronto and Hamilton area during the first half of the year. This represents a staggering 57% decline from the same period 1 year prior, and a 72% drop compared to the 10-year average. To put it into perspective, this was the slowest first half for new condo sales since 1997. Urbanation President Sean Hildebrand explained in a news release that condo prices are still near record highs, and the modest 25 basis point decline in interest rates in June from their 22-year high has not been enough to spur buyer demand. As a result, buyers remain cautious, anticipating further rate cuts and dealing with a burgeoning supply of units for sale. Hildebrand further noted that weakening condo market conditions during the second quarter of 2024 are likely to cause more projects slated to launch this year to remain on hold. Additionally, other projects struggling to meet sales thresholds for construction financing may ultimately be pulled from the market. The report also highlights that the total number of unsold condo units in the Greater Toronto and Hamilton area has now reached a record high of 25,589, equating to about 34 months of supply. This is approximately 10,000 more units than the long-term average. Despite this surplus, prices have remained relatively stable. Urbanation's data shows that the average asking price for unsold units declined just 2.6% over the past year, and by only 4.5% over the past 2 years. This demonstrates how sticky new condominium prices have become due to high development and financing costs, as well as record prices paid for land at the market peak. The Greater Toronto Area's real estate market has faced significant headwinds over the last 2 years due to a significant increase in the price of borrowing. In June, the average selling price of a home across all property types in the Greater Toronto Area was $162,167. This is down from a peak of $1,834,062 in February 2022, which was prior to the Bank of Canada beginning its interest rate hiking cycle. The real estate industry is looking for a boost from the first Canadian interest rate cut in more than 4 years. On Wednesday, the Bank of Canada cut its overnight lending rate to 4.75%, down from a 22-year high. This move is expected to lower the prime lending rate among Canadian banks in the coming days, providing some relief to the commercial property industry, which has been dealing with a significant slowdown. Bank of Canada Governor Tiff Macklem was cautious during a press conference on Wednesday, acknowledging that more rate cuts are likely but tempering expectations. He noted that while higher short-term rates were necessary to curb inflation, they have made things more difficult for buyers and renters. "We have come a long way in fighting inflation," Macklem said. Luc Simurda, Director of Research in Canada for commercial property brokerage Marcus and Millichap, commented that the Bank of Canada believes inflation will continue to trend down, suggesting further cuts will likely materialize over the remainder of the year. These factors will benefit not only consumers, but commercial real estate investors who are awaiting positive signs regarding the cost of debt, Simurda said. While a 25 basis point cut in the overnight rate may not cause a wave of investment activity immediately, it signals to the market that borrowing costs are coming down, providing renewed confidence for many commercial real estate investors. The head of one of Canada's largest residential brokerages agreed that the interest rate cut is a welcome sign for those considering getting back into the market. Phil Soper, president and CEO of Royal LePage, noted that their research indicates half of the sidelined homebuyers in Canada plan to resume their home search once the bank rate begins to drop. This will no doubt spark activity and put upward pressure on home prices in the second half of the year, he said in an emailed statement to CoStar News. Housing analysts at the Conference Board of Canada also weighed in, saying that while lower rates will help the real estate industry, housing affordability will probably remain challenging. Given the high cost of shelter, housing affordability has been at the top of mind for many Canadians, said the Ottawa-based group. In addition to rentals, recent data from Statistics Canada showed a 25.4% increase in mortgage interest costs in March compared to a year earlier. Average home purchase prices have also remained high, despite some pullback in 2023. As interest rates fall and new measures to address affordability are introduced, housing supply will pick up, but only modestly. In our view, the path to better affordability is still quite rocky. Despite the optimism, some caution remains. Carl Gomez from the Conference Board of Canada pointed out that the new reduction is unlikely to spark a surge in home buying and borrowing activity, even if the Bank of Canada continues to lower rates forcefully. Existing home sales in May were down 21.7% from a year ago, while listings had climbed 21.1% during the same period. The average selling price was down 2.5% to $195,409 during that time. Jennifer Pierce, president of the Toronto Regional Real Estate Board, commented that as borrowing costs decrease over the next 18 months, more buyers are expected to enter the market, including many first-time buyers. This will open up much-needed space in a relatively tight rental market, she said. Vacancy rates for apartments hit an all-time low in 2023, while rental rates are close to an all-time high. The next decision on interest rates by the Bank of Canada is scheduled for July 24th. I know this is welcome news to many Canadians, and I also know everybody wants to know where we are headed, said Macklem. Let's just enjoy the moment for a bit. We are taking our interest decisions one meeting at a time. At the recent Land and Development Conference in Toronto, panelists discussed how interest rates were heavily affecting construction and leading to declines in pre-sales of condominiums. Luke Simerda added that with the policy rate likely to fall further over the remainder of the year and into 2025, both land sales and development could see the largest uptick in activity as falling interest rates will allow more projects to pencil out. The central bank hiked its overnight lending rate 10 times starting in March 2022, after it stood at a record low of 0.25% in March 2020, following its last previous cut. Macklem noted those historic lows of years past and cautioned that any subsequent cuts will not take rates that low. "Don't plan on interest rates getting back to pre-COVID levels," he said. Climate-related disasters have been dominating headlines for years now, but their increasing frequency and severity are becoming more apparent. This week's flooding in Toronto is a stark reminder of the growing prevalence of extreme weather events and the urgent need to address their impacts on real estate. As natural disasters like wildfires and floods become more frequent and severe, the impacts on home financing are growing, leading to increased risks for lenders and higher costs for homeowners. In 2023, insured damage from natural catastrophes and severe weather events in Canada reached over $3.1 billion, marking the fourth worst year on record for insured losses, according to Catastrophe Indices and Quantification Inc. Between 2009 and 2021, claims surged to an average of $1.96 billion per year, with more than half of this increase attributable to flooding. By comparison, between 1983 and 2008, insurance claims for climate-related events amounted to about $250 to $450 million per year. The past year saw a range of extreme weather events across Canada, highlighting the increasing severity and frequency of natural disasters. Some of the noteworthy events last year included the Atlantic Canada cold snap, the spring ice storm in Ontario and Quebec, the Tantalon wildfire in Nova Scotia, extensive flooding in Nova Scotia, severe summer storms across the prairies, wildfires in the Okanagan and Shuswap areas of British Columbia, and the Bachoco, Yellowknife, and Hay River wildfires in the Northwest Territories. More recently, mere days ago, Toronto was inundated with nearly 100 millimeters of rain, leading to widespread flooding of roads and basements, which the Insurance Bureau of Canada estimates could top $1 billion in residential and commercial damage. A week earlier, the remnants of Hurricane Beryl drenched southern Quebec, resulting in record-breaking rainfall in Montreal and similar widespread flooding. This came less than a month after the Quebec government released estimates that nearly 77,000 homes, or 2% of the province's population, could find themselves in a flood zone based on new flood maps that are set to be released. That would be up from the 22,000 homes currently in flood zones today. The increasing frequency and severity of climate-related disasters should be of concern to all Canadians, even if they have yet to be directly affected, said Craig Stewart, Vice President, Climate Change and Federal Issues, Insurance Bureau of Canada. The homes and financial health of over 1.5 million Canadians are at high and growing risk, he added. The increasing frequency and severity of extreme weather events are prompting urgent action in the mortgage industry. The latest annual report from the Canada Mortgage and Housing Corporation highlights wildfires and floods as top priorities for assessing business strategies, operations, and financial plans. Consequently, mortgage lenders and insurance companies throughout Canada are adapting to this new climate reality. Climate risks affect multiple areas, including credit, market, and operational risks. In 2023, the Canada Mortgage and Housing Corporation conducted qualitative assessments of climate-related risks and incorporated the findings into their quarterly risk management reports. The Canada Mortgage and Housing Corporation's key climate-related concerns include increased borrower defaults and declining property values due to extreme weather events, rising demand for affordable housing driven by migration from hazard-prone areas, strained supply chains and increased costs from rebuilding damaged infrastructure. Regarding its own balance sheet, the Canada Mortgage and Housing Corporation acknowledged its significant exposure to flood risks, with a notable percentage of insured loans and balances located in high-risk areas for both riverine and coastal flooding. Focusing on properties with a flooding probability of at least 1 in 100 years, the Canada Mortgage and Housing Corporation estimates its exposures are homeowner mortgage loan insurance business, 4.2% of insured loans, 34,717 out of 830-831, and 3.9% of insured in-force balances, $6.7 billion out of $172 billion. Multi-unit mortgage loan insurance business, 3.1% of insured loans, 834 out of 26,979, accounting for 3.3% of the total insured balance, $4.25 billion out of $129.5 billion. Mortgage funding business, 4.3% of all National Housing Act mortgage-backed securities loans, 93,182 out of 2,147,646, and 4.2% of the overall balance of securitized loans, $19 billion out of $453 billion. The impact of extreme weather events on home valuation is becoming increasingly evident, with severe flooding, in particular, having a profound effect on the residential housing market. According to a report released by the University of Waterloo's Intact Center on Climate Adaptation, flooding can lead to significant changes in the real estate market in the 6 months after flooding events, compared to the 6 months before. An 8.2% reduction in the average sold price of houses, a 19.8% increase in days on the market, a 44.3% reduction in houses listed for sale. To put this into context, for a house priced at the Canadian average of $713,500 as of December 2021, a neighborhood subject to catastrophic flooding could see the house sell for $654,993, reflecting a flood discount of $58,507. In most cases, the impact on the real estate market is temporary. Doug Farmer, Assistant Vice President of First National Financial, told Canadian Mortgage Trends that if the value of a home is affected by an extreme weather event, its value will be restored again over time, when necessary repairs are made and the marketability of the area evolves in a more positive trend. In general, over time, the market values do return, he said. But that's not necessarily the case for select areas that can experience near-annual severe weather events, notes the Intact Center report. A case study for Fredericton, New Brunswick found that for such communities, the impacts of regular flooding can have long-lasting impacts on the market. For communities within cities that flood on a near-annual basis for at least a decade, versus 1 or 2 catastrophic floods per decade, the impact of flooding can be priced into the real estate market permanently, the report notes. The good news in terms of residential mortgages is that the net impacts of catastrophic flooding on mortgage arrears and deferrals showed no consistent or material impact across 2 Canadian cities, according to the report. The rate of arrears and deferrals in flooded versus non-flooded communities largely fell within market norms, indicating that factors other than flooding may be more consequential to mortgage delinquencies. The total number of arrears and deferrals in flood-impacted and control regions ranged from 0.32 to 7.07 per 1,000 homes over a 6-month period, which translates to a worst-case scenario of 1.18 arrears and deferrals per 1,000 homes per month, the report found. The consequences of flooding appear to be relatively immaterial regarding mortgage arrears, particularly considering that impacts would generally last only a few months post-flood, the report noted. While the lasting impact on home valuations from extreme weather events can be temporary, lender risk appetite can be impacted indefinitely. During the 2013 Alberta floods, for example, Farmer says most damaged houses were then remediated or rebuilt by the insurance companies or other financial means. He said communities have done their best to prevent damage from flooding going forward, but some lenders are still reluctant to work in these regions. There's certain lenders that won't go there, he said. It's their duty to protect investors' and depositors' money, and they've set their risk assessment parameters accordingly. However, in general, there are still numerous mortgage lending options available in these regions, so long as the buyer is able to get appropriate insurance. All of us lenders have our red zones, areas that we would scrutinize more closely as far as risk assessment goes, said Hallie Noble, Senior Vice President of Residential Mortgage Investments and Broker Relations at Fiskard Asset Management. Certainly, there are areas that have had a lot of issues in the last few years for forest fires, but as long as we're covered by appropriate insurance, and that's part of our underwriting package and one of our conditions to fund, we're okay. Noble emphasizes that no lender would finance a mortgage without proper insurance coverage. Those insurance policies are extremely important, and what's covered within those policies and how those policies are going to protect the lender, and ultimately, our mortgage investment, she said. Depending on the region, however, some lenders are reconsidering their lending practices in areas vulnerable to severe weather events. In February, Desjardins Group announced changes to its underwriting guidelines and will no longer offer mortgages for properties that fall within certain flood zones. Specifically, parts of Île-Bizarre and Île-Mercier in Quebec, which saw severe flooding in 2017 and 2019, will be impacted by the credit union's decision. The impacts of climate change, including water damage, are growing in importance and causing substantial damage, Desjardins said in a statement. Homeowners affected by flooding and wildfires typically rely on insurance companies to cover the costs of repairing or rebuilding their homes. However, additional expenses during this period can impact their ability to make timely mortgage payments. Farmer notes that many companies have implemented structures to support homeowners through these difficult times. These measures may include delaying mortgage payments and adding them back to the principal or extending the amortization period, depending on the individual situation and financial needs. Nobody wants to see someone lose their home, Farmer said. So there's many vehicles in place to help people through these difficult times. The Financial Consumer Agency of Canada has established guidelines for banks to provide tailored support to individuals struggling with mortgage payments due to exceptional circumstances, such as natural disasters. These guidelines include mortgage payment deferral. Homeowners can delay mortgage payments for a specific period, usually up to 4 months. Extended amortization period. Extending the amortization period to lower monthly payments, although this may increase the total interest paid over the life of the mortgage. Special payment arrangements. Temporary reduction in mortgage payments or capitalization of missed payments and related costs. Additionally, federally regulated financial institutions are expected to proactively offer relief measures, such as waiving late fees and not reporting missed payments to credit bureaus if relief measures are in place. These measures help to alleviate the financial burden on homeowners, ensuring they can maintain their homes during recovery periods. Mitigating the impacts of extreme climate events, particularly flooding, on residential properties is a growing concern in Canada. Several strategies and resources are available to help homeowners and communities reduce these risks. Banks, credit unions, real estate brokers, mortgage providers, and property and casualty insurers are increasingly distributing the 3 Steps to Cost-Effective Home Flood Protection infographic. This resource provides practical steps for homeowners to reduce the risk of basement flooding, most of which can be implemented with minimal cost and no special expertise. Launched by the Federal Government of Canada in 2021, the Climate Adaptation Home Rating Program helps homeowners navigate the flood retrofit process. It complements EnerGuide home energy audits and expands the eligibility requirements of the Canada Mortgage and Housing Corporation's Deep Home Retrofit Program and Canada Greener Home Grants to include more climate resilience and flood risk mitigation measures. Federal, provincial, territorial, and municipal governments are updating flood risk maps to assist city planners, developers, engineers, and municipal risk officers in identifying and mitigating high-risk areas. These maps also help homeowners make informed decisions to limit flood risk. A proposed system would establish a flood risk score for residential properties based on address or postal code, similar to the system in the United States. This score would help homeowners understand and mitigate their flood risk. Communities can use guidelines from the Standards Council of Canada and the National Research Council to identify high-risk areas and deploy mitigation actions. Some areas may require more substantial and cost-effective remediation efforts. The bad news regarding the impact of flooding on residential housing is that climate change and extreme weather-related flood risk, at times combined with poor land use planning, will get more challenging across many regions of Canada, and if left unchecked, will increasingly distress the residential housing market, warns the Intact Centre. The good news is that Canada has developed, or is in the process of developing, a wealth of guidance to help homeowners and communities to mitigate flood risk, it adds. Our next topic is an important one for many homeowners: renewing your mortgage after financial changes. A recent article by Kurt Wook, published on July 18, 2024, delves into how changing financial situations can affect your mortgage renewal process. Let's break it down. According to the Bank of Canada, about half of all homeowners who took out a mortgage before interest rates began to rise in February 2022 have yet to go through a mortgage renewal. By the end of 2026, nearly everyone in that group, over 2 million homeowners, will renew, according to an estimate by the Canadian Mortgage and Housing Corporation. This means that many borrowers will not only face higher rates, but also might find themselves in a different financial situation than they were a few years ago. Changes in household income, debt levels, or credit scores can complicate the renewal process. Even if your situation results in fewer options than you would like, proactively seeking expert guidance can get you closer to the best possible outcome. Let's talk about some common scenarios and what you can do about them. First, let's discuss what happens if your income has changed. According to a 2023 Bank of Canada report, the impact of higher interest rates on borrowers' ability to pay their mortgage will largely depend on their future income. Without any income growth, the median borrower may need to dedicate up to 4% more of their pre-tax income to mortgage payments by the end of 2027. If your income has dropped, that burden is even higher. Naomi Ham, a mortgage broker with Centum Mortgage Choice in Brandon, Manitoba, advises sitting down and thoroughly examining your specific situation. For example, in areas where home prices are not as high, such as Brandon, Manitoba, the payments might not be as daunting as they appear. Comparing offers from several lenders is the best way to secure a favorable rate. However, if your income has dropped significantly, you may have fewer options to consider. Before you can switch to a new lender, you will need to requalify by passing the mortgage stress test, which compares your income to your debt. If your income-to-debt ratio has dropped too far, your fallback option is to stay with your existing lender, who will likely offer you a renewal without requiring you to requalify. On the flip side, if your income has increased, you might be in a stronger position to requalify elsewhere. Working with a broker can reveal creative solutions, such as opting for a shorter term if you expect your income to increase in the near future. Another common scenario is a change in your source of income. Moving from one salaried position to another, comparable ones should not be an issue if you are shopping around for the best rates. However, if you have transitioned from earning wages to being self-employed, you will need to establish a track record. Most lenders want to see 2 years of consistent earnings before considering you for a mortgage. If you are new to freelancing, you can count on a renewal offer from your current lender, but you may have limited options when shopping for better rates. If you are planning to transition to self-employment in the future, consider the timing of your next renewal before making the switch. Similarly, if you have retired, lenders will want to review any pensions and retirement account balances you have. Speaking to a mortgage expert can help you avoid complications when renewing your mortgage in these scenarios. Lastly, let's talk about changes in your debt levels. Carrying additional debt can hurt your chances of qualifying for the best rates at renewal, but it is not always a deal breaker. According to Naomi Ham, what matters most is your track record of paying bills on time. A higher mortgage payment plus other debt obligations can put homeowners in a pinch, but the mortgage stress test exists to ensure you can cope with total debt loads if interest rates rise. The bottom line is that there are many reasons a homeowner's financial profile can change. Retirement, starting a family, losing or changing jobs, just to name a few. While these changes can lead to challenges at renewal, there is always an optimal path. Reviewing all available options is the first step to choosing the best one. Working with a mortgage broker is the most efficient way to do this, and they typically will not charge you for the assistance. That wraps up our episode for today. Thanks for tuning in to episode 20 of the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Himowen. Stay informed, stay prepared, and until next time, take care.